Hello and welcome to today's video on tax education, the basics, specifically for childcare businesses. In today's video, we'll discuss how you can decrease the impact of taxes on your business. We'll provide you with the background and tools for tax education that you need, and we'll discuss some foundational topics around taxes to think about why they're important, with a focus on the Schedule C. We'll also look at some key opportunities that we don't want you to miss.
The information contained here has been prepared by Civitas Strategies Early Start and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies Early Start team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited.
Knowing how to effectively address your taxes can help you to keep your hard-earned money, reduce your chances of a costly audit, be aware of how healthy your business is financially, and then, as a result, help you to worry less about your business. These topics will be broken up into 3 different video sessions. First, today, we'll be going over some basic concepts and providing a basic understanding of the Schedule C form. In session 2, we'll be addressing key opportunities for your taxes. And in session 3, we'll be going over tax tools and frequently asked questions. So let's start off. Why are taxes important? And what is the Schedule C? What does it look like? And how do I know how to fill it out? Luminary Evaluation Group conducted a study of childcare business taxes from 2019. This all occurred because childcare business owners elected to share their taxes to see what opportunities existed for them to improve on their tax returns insofar as correct reporting and maximizing on their deductions. Ultimately, Luminary Evaluation Group found that 83% of childcare providers that operated out of their own homes did not claim the business use of home at all. All home childcare providers can claim business use of home. So this was a deeply disturbing finding because this means that many dollars were left on the table. We definitely want to make sure that we're claiming all of our business-related expenses on our taxes for our business, right? We found that Luminary Evaluation Group found that some providers were not claiming any business expenses on their tax returns. Certain business expenses were being misclaimed, or in other words, they were being put on the wrong place on their tax returns, or they were being incorrectly calculated. And the IRS has certain indicators for certain industries that send up red flags in their systems. So if you're a childcare provider and you're filling out information on your Schedule C that is inconsistent with childcare business practices, then you are more likely to be flagged by the IRS for audit. Today's presentation will provide information about the appropriate way to fill in your expenses so that you are actively reducing your chances of an expensive and time-consuming audit by the IRS, right? IRS audits can be time-consuming and extremely expensive, so it's important to care about our taxes because we want to reduce the likelihood of that IRS audit, right? We want to retain our profits, we want to maintain and improve our business health. All of this means that we're mitigating risk and we're increasing our confidence in our business. So now that we understand why we should care about taxes, let's dive into how taxes work. At a very high level, if you take nothing else from today's presentation, remember this: your profit is not your bottom line. The money that your business takes in minus the money that goes out of your business is not your bottom line. To get to your bottom line, you need to consider how your business expenses can reduce your taxes, okay? Once deductions from a year are added together, the total amount of deductions reduces the amount of money that the federal government sees as what you should be taxed on. What this means is really that your business takes in revenue, right? And then your business also sends out money for expenses. When it comes time for tax season, the business owner and or its financial staff or contractors are responsible for tracking the business expenses to reduce the amount of taxable income owed to the federal government. So ultimately, the more committed you are to tracking your business expenses and sharing them with your tax preparer, the greater the likelihood that your taxable income will decrease, which in turn decreases your annual tax bill. If you are a self-employed small business owner, you are subject to a 15.3 self-employment tax of your profit or your net earnings after all your expenses have been subtracted from the revenue. You are also subject to your general income tax rate on your profit. Let's dive into how deductions work. Let's say you are a sole proprietor and you earn $35,000 in revenue. If you claim no deductions, the federal government will see that your net profit subject to tax is $35,000. If, however, you claim $35,000 in revenue, and then you are also itemizing the money that you spent in eligible business expenses as deductions on your business, then your tax liability, or the amount of taxes that you will owe, will be lower. So let's say, as a sole proprietor earning $35,000, you spent $5,000 in business expenses, eligible business expenses, throughout the year. And therefore, you claim $5,000 of those business expenses on your taxes. If you don't put on your taxes those $5,000 in business expenses, the federal government is going to tax you at $35,000 net profit subject to tax. However, if you claim on your taxes that you spent those $5,000 that you did on business expenses, then the federal government will only see your net profit subject to tax as $30,000. So that's $5,000 that you will not be taxed on. That ultimately is more money in your pocket because it's less taxes owed. Ultimately, maximizing your eligible tax deductions for your business can help you reduce how much money in taxes you will owe each year. The majority of childcare providers use a Schedule C to file their taxes. Now, the Schedule C is only used by sole proprietors. So that means family childcare providers and small center providers operating as sole proprietors. We're mainly going to focus on the Schedule C during today's video call, but there is still useful information for childcare providers of all sizes, including large centers, in today's presentation. The Schedule C of your Form 1040 starts off by asking you basic information about yourself and your business. You'll enter the sole proprietor's name and their social security number, the business name, business address, type of accounting method used. This is pretty basic information about your business. Part 1 of the Schedule C asks you to report your income. This includes your gross receipts, your gross profit, and your gross income. Part 2 asks you to report on your business's expenses. This is the area of your tax return where you're able to capitalize on your eligible business deductions. When you add up all of the amounts that you spent on these different line items, it reduces your overall net profit that the government sees is due for you to be taxed on. So for instance, there are many areas here that child care providers often use. Let's look at number 8, advertising. Let's say you do a Google marketing campaign, and let's say that costs you $200 for your business. That should be one of the expenses that you add up within your advertising budget to add to number 8. If you only spent $200 on marketing and advertising in this past year, then number 8 would read $200, and that would reduce your overall taxable income by $200. Through the rest of today's presentation, we'll go through areas that you can capitalize on within your expenses to reduce your overall taxable income. In the last half of the expenses section, you'll add up your total expenses before expenses for business use of home, and then you'll add up all your expenses for business use of home that you are not reporting elsewhere. You'll also find your net profit or loss. That's on line 31. Additional instructions follow. So as we've already discussed, there are some deductions that are common for child care programs to claim that are often overlooked. Next, we'll go through some of the most commonly missed deductions that may provide you an opportunity for your business. First, business use of home. Home-based child care providers can claim the business use of their home on their taxes. To determine the business use of your home, you will use the time-space calculation. Now, if you've never heard of the time-space calculation before, all that means is that you'll be figuring out of all the space in your house, what portion of that space is used for your child care program, and of all of the time in a year, how many hours are used for a child care program. Together, those two figures will give you, when multiplied together, your time-space percentage, which can then be applied to expenses associated with your home, such as rent, utilities, or mortgage interest. We'll dive much more deeply into business use of home in subsequent videos in this series. Insurance may be deducted as well, but make sure it is business-related insurance costs, such as liability insurance. You cannot include your personal or health insurance. Keep in mind that if you are claiming business use of home as a family child care provider, you want to make sure that you're not including your home insurance costs twice, right? It's going to be counted in your business use of home because your home insurance is insuring your home for not only when you are in it personally, but also during business hours, right? Make sure to exclude home insurance from the insurance line and include home insurance in your time-space calculation. If you operate a child care program that is out of a commercial property or any place that's not your home, then you can claim mortgage interest as a deduction. If you are a home-based provider, your mortgage interest is already captured as a deduction when you use your business use of home time-space calculation. If you have W-2 employees, the total salaries and wages for the year can be deducted on your taxes. If you are a W-2 employee, then you can deduct your own wages on your taxes as well. If you are not a W-2 employee, if you are a sole proprietor, then you cannot deduct the money that you pay to yourself. Also, importantly, note that 1099 contractors cannot be claimed in this line, only W-2 employee wages. Also, supplies. Think about how many supplies that you need to purchase to keep your child care program running. This can go from crayons and learning materials to curriculum supplies, to toys, to diapers and wipes. Think about things like cleaning supplies as well. All of these things can be included as a supplies deduction on your taxes.
Additional resources for early care and education can be found at the Wisconsin Early Childhood Association or WECA website. If you are not a member of the Wisconsin Early Education Shared Services Network, you can click here to learn about business training and support it offers. If you are ready to join the Wisconsin Early Education Shared Services Network, you can also click here to join